Hey guys, welcome back. If this is your first time here, I'm Neil, the Adventures Investor. On this channel, we talk all things investing, business, finance, anything in that sort of nature. If you enjoyed today's video, guys, it'd be much appreciated if you hit the like button. And if you want to see some more videos like this moving forward, then hit the subscribe button. With that said, let's jump into it. Like I say in every other video, I'm not a financial advisor. Anything we talk about today is purely educational, so I'm not too sure of your financial situation or anything like that. So we're just going to be running through a LIC today, okay? A listed investment company listed on both the ASX and the NZX. And we're going to be sort of breaking it down and comparing it to an ETF, an exchange traded fund. If you're unsure what both these are, I've done a couple of videos on them. So today we're just going to be looking at the LIC predominantly, but I'm going to use it in comparison to an ETF because an ETF is another commonly traded thing, especially when you're starting out investing. Gives you good diversification across an entire index usually, or multiple indexes depending on the ETF that you're looking at investing in. So this LIC we're looking at today is AFIC, okay, Australian Foundational Investment Company. Great sort of LIC if you're starting out on your investment journey and you want good diversification across the entire ASX, okay. The main sort of key differences between a LIC and a ETF is the LIC is an actively managed fund or company, sorry. So, you know, there's someone actually buying and selling and making decisions on what the particular companies invest in. Where an ETF, on the other hand, is a lot more passive. It's all hands off. And let's say VAS, one of the, you know, famous sort of Australian ETFs, let's say, that's passively managed, and that's just always going to hold the top 300 companies at that given time, just always on there. It's all sort of happening in the background. No one's actually sort of making decisions on what goes or buys and sells in that particular ETF. Whereas the LIC, which we're talking about today, AFIC, it's actively managed. Okay, so you know there's people making decisions on what they're buying and selling, which you know sometimes generally they're trying to outperform the market. Generally, you find you know they pretty much stay in line with the market, which is great. Sometimes they may slightly outperform the market, whereas an ETF will generally just track the entire market. But bear in mind, if the market tanks, then generally the ETF will follow suit. Whereas in you know a listed investment company, because there's people actually actively managing it, then they will try and minimize their losses. Okay, so it may not be affected as heavily as what a ETF would in case of a correction. So something to bear in mind when you're looking at investing into LICs and ETFs. So we're going to explore how much the dividends are that AFIC currently pays. We're going to be looking at their top 25 holdings within the company as well. We're also going to have a quick look at the net tangible assets of AFIC to see where they're sitting at value-wise today. Are they a good value play today? And try and sort of gauge whether it's a good time to be investing in AFIC, okay? So stick around to the end, so make sure you watch that. With that said, let's jump into it. Alright guys, so here we are on afi.com.au. I'm going to leave a link to this in the description below, so by all means do all your own research around this as well. Don't just take my word from it, but we're just going to be looking over a couple of the key things. Like I said, we're going to look at the dividends they're paying, what they're currently invested in, their top sort of 25 holdings, and have a quick look on the net asset backing or the net tangible assets of this company as well. Just going to quickly scroll through this website here, just so a couple of key things that you can pick up on. So Australian Foundation Investment Company, an easy way to invest in Australian companies. Okay, so here we have the current share price at $7.15, net asset backing at $6.03. So remember that. We're going to talk about that in a bit, but just remember those sort of key prices there. So we're going to scroll down. So they've been around since 1928, so they've got a solid track record. Diversified portfolio, yep, like I said, 80 to 100 different companies, predominantly across the ASX. Very low cost, okay? So the management fees of this company are only 0.13%, but we'll talk about that in a little bit later. Some key facts, so they've got over 7.2 billion under management. Fully franked dividend coming in at 0.24, so 24 cents there. This is every per annum. Sometimes they have done some special dividends in the past, but this is what they'll currently be paying this year. And like I said about the management coming in at 0.13%, this is a great sort of management expense ratio. Whenever I'm looking at ETFs or LICs, anything like that, then you always want to look at how much they're creaming off the top. This is a great, especially for an actively managed fund, which this is. Whereas ETFs, like I said, they are passive. It just tracks the entire index. So especially like VAS, Vanguard Australian Share Fund, they just track the top 300 companies, okay? So that's just all sort of happening in behind the scenes. There's no one actually sort of making the calls on how much they should buy in BHP or Westpac or whatever they may be looking at, whereas this is actively managed, okay? So that's a couple of key things there. Here we have the net tangible assets, okay? So share price to net tangible assets. So what does this actually mean? So it's the share price and then
what's it actually backed on, okay? So the net tangible assets, the NTA, you'll see this on a few different things, especially if you're starting to do your own research on Yahoo or Westpac or whatever particular share trading platform that you buy or sell your securities on. That's another quick thing, guys, just before we move on. This is publicly traded on the ASX and the NZX, so you can just buy this through your regular trading platform, wherever that may be, which I highly recommend. You'll need to open up a share trading platform, whether that's with Westpac or CommBank or ANZ or whoever you bank with or you want to trade shares with. So it can be openly bought and sold through there. You don't have to invest just with this particular company. It can just be bought and sold on the public market as well. Okay, so let's have a quick look at the net tangible assets here. This is something they like to feature on their website, which is quite cool, I think. So let's say net tangible assets. So let's say, just reading over their example here, net tangible assets per share, so NTA, is the value of the total portfolio divided by the number of shares on issue. Okay, so using a simple example, if the value of the total of the portfolio is $100 and then the shares on issue is 10, then the net tangible asset is $10 per share. So that's for every share, it's backed by $10 worth of assets. Okay, so just another little example down here. So NTA per share, $10, share price $11. So that means that the share price is currently trading at a premium. So net tangible assets per share, but the share price is currently $9, then it's currently traded at a discount. Okay, so let's have a quick look back over here on that first page. So the current share price is $7.15, where the net asset backing is only $6.03. So that's all the different companies making up this particular company is only worth $6 or $6.03 per share. Okay, so that means that currently AFIC is currently trading at a premium to their net asset backing. Okay, so that's something to bear in mind if you're wanting to go down this road and invest in AFIC as well. But I think if you're investing for the long term, more that 5-10 year sort of approach, then it's a great company to buy in at sort of whatever price point. But always just sort of another key thing to sort of look out for when you're investing in LICs or ETFs or whatever you may be investing in. Here we have, this is just more about the net tangible asset value. Just a couple of quick things here. Like I said, this is the latest as of 31st of October 2020. Before tax, like I said, the $6.03 there. The key benefits of this is diversified portfolio, primarily of ASX listed Australian equities, tax effective income via fully franked dividends. Here we have size of portfolio, 7.4 billion at 31st of October 2020. Management fee, like I said before, 0.13%. Like I said, this is all found just on their website. I'll leave links in the description below. Let's have a quick look at the performance of the company as well. So they haven't had a great year this year. Obviously, there's been a big correction in the market. We all know why. So they're actually currently down this year, whereas the 5-year return coming in at 8.1%. And so here we have just these two different graphs here. The left one here, the blue, that is what the AFIC has performed. And then the one on the right is how the S&P as a broad index, how they've performed. So they're slightly just trailing on the 5-year return there. So that's what the broad index has returned over the space. Whereas if you're just investing with an ETF, that's more where you'd sort of be sitting. So they're currently slightly under that. And then if we look at the 10-year return, they're slightly over it. Okay, so the 8.7% over the 10-year return, whereas the S&P over the last 10 years has returned 8.5%. This is on a per annum basis as well, guys. Here's another quick graph over the premium discount to net tangible assets. So if you can see, look back here in October 09, 10, 11 and all that, they were trading at quite a good discount to their net tangible assets, like sort of looking at that's about 7 or 8% sort of below what the actual net tangible assets of the company were. And it's sort of been up and down a bit over the years. And like I said before, they're currently trading at a premium to their price. So that's something to bear in mind as well. We're just going to have a quick look at the dividend that AFIC is currently paying. So coming in at 14 cents, this is on 1st of September. Dividend yield at 3.4% with 100% franking. Okay, so what does this mean? This eliminates any double taxation. So they've already paid a share of the tax. So, they're not paying tax and then you're having to pay tax as well. So this eliminates that, which is a great thing to have. A lot of big companies, especially the blue chip companies, generally like to have 100% franking, as these guys have, and they've been paying 100% franking since 94. We'll look at that in a quick second. So this is a great feature, especially if you're a dividend investor and you're looking to, reduce your taxes come the end of the tax year. This is a great feature to have. Not all countries do this, but Australia is a big fan of this franking credits, which, like I said, the company's already paid a portion of the tax, which they then pass on to the shareholder, which is you. And then, this can reduce your tax bill at the end of the financial year, depending on your tax bracket as well. Dividend stability coming in at 99.1%. I'm not too sure why they haven't given them 100%, but maybe they can't. The ex-dividend date and the pay date. So let's just have a quick run through the dividends here. Like I was saying, that's the most recent one there, 1st of September 2020. At 14 cents, 100% franking level, like I was talking about earlier there. You can also set up a dividend reinvestment plan with them as well. So rather than take the payment, you can just receive more shares with AFIC as well, which is a great way, especially if you're early on in your investing journey and you don't require a payment from them with a dividend. Then you can just get these dividends reinvested and slowly building up your share portfolio with AFIC as well, giving you great diversification. Like I said, you're getting the top 80 to 100 companies currently in Australia. But we scroll down here, as you can see, they've been increasing their dividends slowly over the years, but they haven't missed a dividend. This is especially right through here, through February and August 2008. This is when the recession was obviously kicking on. Didn't miss a beat there, still kept paying the dividend, didn't reduce, didn't cut or anything like that. Just kept maintaining, paying these dividends. Great if you're a retiree and you're relying on this to top up your pension or something like that. So really solid to see. And then if we go back a bit further even, we can see right back. So this is from August 2005, scrolling down, like I was saying about that franking level, 100% all the way through. And this is through here, through the tech boom in 2000, .com bubble. Like I said, didn't reduce dividends, kept paying those dividends all through that whole period there. Kept going through. And this is when they started. So from 94 onwards, so October 94 was when they started paying those 100% franking credits as well. So and then we've had a few special dividends along the way. So you can see here 2001, a couple of little extra dividends just to top up. So anything with these in asterisks is just little extra dividends on top. So let's wrap that one up there. Actually, let's have a quick look over what the top 25 investments of AFIC are. So let's quickly scroll down and have a quick look. So their top holding, this is the top 25 holdings of their portfolio. Top 25, CSL coming in at 620 million, and that's 8.5% of the portfolio. Commonwealth Bank coming in at 7.5 there. We'll just quickly scroll through the list here, just so you get an idea of the companies that you're invested in, or what AFIC is invested in. And if you're buying a share, then you're getting a small piece of all this action. And it's all names that you've seen and commonly know, like obviously CSL, Commonwealth Bank Australia, BHP, Wesfarmers, Transurban, Westpac, Macquarie Bank, Woolworths, NAB, Rio. They're all there. Mainfreight, ANZ, James Hardie, Telstra, Sydney Airport coming in 1.9, Coles Group, Brambles, Fisher & Paykel Healthcare, and then that's the top 25. So that makes up 75% of their portfolio. All right, guys, we're going to wrap that one up there. If you've got any questions or anything I covered off on there, just drop it in the comments below and I'll do my best to help you out.
All right, guys, hope you got some value there from looking over a couple of the key facts from AFIC. I think this is still a great long-term play, sort of more of a 5 to 10 year sort of range rather than a couple of weeks or something like that. So bear that in mind. And if you're reliant on dividends, also another great sort of long-term play as well. With that current price is paying that 3.4% dividend. Especially like this year, we noticed a lot of the big companies, the banks and all these big companies that are famous for paying, good, steady, reliable dividends, they've cut their dividends or heavily reduced their dividends this year. And, they might be another year or two before they sort of fully really reinstate those dividends. So, whereas AFIC, on the other hand, they didn't cut their dividends whatsoever, still paying 100% franking credits. And they've just been doing this consistently for like the last 20 odd years. So definitely a good key thing to know from this company is, they pay reliable dividends, and they've been through some downturns of the market and they've still kept these dividends at the rate. They haven't reduced them at all, and they've just kept slowly increasing these dividends over the last 10, 20 years as well. So definitely a good dividend payer, let's say. And you're getting good diversification across the entire Australian market, okay? You're getting the top 80 to 100 different companies here, and it's actively managed rather than passively managed like an ETF is. So this would be great to sort of pair with an ETF as well, especially if you're more of a passive investor rather than an active investor investing in individual companies. This would be a good, step just into the world of investing if you're just sort of starting out on your investing journey and you're a bit unsure, you're a bit uneasy about what company to buy into. I think this is a great sort of base level foundational sort of start to a portfolio, as well as with a couple of ETFs as well. They sort of perform about the same, but the biggest thing to remember is that this is a publicly listed company, and it is actively managed rather than an ETF, which is passively managed. There's actually people behind this making decisions, what they're buying, what they're selling, and all that sort of thing. So bear that in mind when before you're investing into this LIC. But like I said, everything I talk about in this video is purely educational. I'm not your financial advisor. I'm just a random bloke on the internet just yarning about investing, so bear that in mind as well. Do your own research, but everything I've talked about today, I'm going to leave links in the description below so you can do your own research and learn about AFIC. But have a talk to a financial advisor or anything about this as well, see what they say about it. Scott Pape's always a big fan of AFIC as well. He's been sort of swearing by it for the last long as I've been following anyway, and with good reason. They are a solid company, so also another good guy that's backing this company as well, so good things to sort of take into account when assessing AFIC. With that said, guys, I'm going to wrap it up there. If you enjoyed today's video, it'd be much appreciated if you hit that like button, and if you want to see some more videos like this moving forward, then hit that subscribe button and you'll be the first to know when the next video drops. Okay guys, stay safe out there in your investing journey, and we'll catch you in the next video. Cheers guys.